Welcome to Academic Academy SA. If you're new here, welcome. If you're returning, welcome back. Please don't forget to like, subscribe, share this video, and turn on your notification bells so you never miss an upload. Now, let's get started. Welcome once again to Academic Academy SA, guys. So today we'll be covering the accounting equation for grade 10 to grade 12 accounting. So if you're doing accounting in any of these grades, then please do make sure to watch this video until the end. This should not be long because this is a very simple topic, and once you master it, it'll just make things easier for you in the exam. So basically, the accounting equation, right, shows the relationship between assets, liabilities, and equity. So now the formula for the accounting equation is assets is equals to liabilities plus equity. And you need to bear in mind that when we're talking about equity, we are talking about anything that has to do with profit or capital. So with that being said, there is something in accounting that we call a cross-reference, right? So this basically means that for each credit, there should be a debit, right? So for example, if we receive 500 rands from sales, right? Now the way that you would enter this is you would have your asset income, your asset account and your income account, right? And we know that with income increases on the credit side and decreases on the debit side, and vice versa for the asset account. Therefore, you would then credit the income and debit the asset account. Now, why are we using the ledgers in this topic? Using ledgers is going to help you understand exactly what happens with these transactions. So we will go over them before we get into the practical example. So with that being said, this is just something that you could see, right, in a test or in activity on this topic. Now, if a liability is paid off, this means that equity is going to decrease. Now, why is it decreasing? Now, for us to pay it off, we need to take the money from somewhere to pay off this liability, right? So we will either take the money from our profits or from our capital to pay this liability off. Therefore, the equity will decrease. And if an asset increases, right? If an asset increases, this could be us buying equipment or receiving money, right? Then obviously equity should increase, right? It's as simple as that. So now we are moving on to the ledger accounts that you would need in order to fully understand the accounting equation. So when you draw a ledger, this is basically what you are supposed to draw right here. So you draw a T account. As you can see, it is shaped like a T. Then you have the name of the account. Then you have your debit side here and your credit side here. Now, guys, it is always like this. You will never have your debit side on this side or your credit side on this side. This is basically how it is. And the way that I would make sure that I always never forget this is I would call it Dr. Credit, right? Because then as it is, we have our DR on the side and our CR on the side. It's a simple trick to always ensure that you never forget this, right? So the first ledger account that we'll be looking at is your assets, okay? You're looking at the assets. Now, with your assets, right, it increases on the debit side and it decreases on the credit side, right? And the next one is your drawings, okay? Your drawings. Now, drawings are very similar to the assets. They increase on the debit side and they decrease on the credit side. And we move on to expenses. Now, for expenses, they increase on the debit side once again, and they decrease on the credit side. Now, moving on to the ones on this side, we just remove this right here. Moving on to this side, we have the first one is a liability, right? Now, a liability is the opposite of a asset. Now, with that being said, we know that it will increase on the credit side and decrease on the debit side. Then we have a capital account, right? A capital account increases on the credit side and decreases on the debit side. And then we have the income account, right? Now with the income account, this is going to increase on the credit side and decrease on the debit side. Now with that being said, this should help simplify what you need to do with a accounting equation problem. Because for example, right, if you pay off a liability, right, you pay it off, of 500 rands perhaps, right? Now, let's say you are told that this is taken from your income account, right? So the first thing that you need to know here is that the liability is going to decrease. So you're going to have your 500 here, right? It is going to decrease, right? And then let's say you take your money from your income account, also known as your asset account, because remember these two are correlated, right? When you have a plus on this side here, it goes to the side here. So when it is like this, right, you would then just have a decrease on the asset account right here, right? It would be something like this. However, this is not a proper example, so we are now going to jump into the practical example so that we can do this properly. However, I hope that you are writing this down somewhere, right? Write this down, know the formats and all of that so that you can maximize your chances of totalizing that accounting paper, guys. Okay, so we are now in the practical example. So the first transaction says that the owner started a business with a balance of 50,000 rands in the bank as a capital contribution. So now we know that bank is an asset, right? So what do? We increase the asset by 50,000 and then we increase the equity by 50,000. Because remember, here we said that we have equity and profit, and as you can see, our capital, I mean to say our capital, my apologies. Here by equity we have capital and profit, and you can see that there is an increase of capital with 50,000 rands. And here you can either put a dash or you can put a 0, but never ever leave this thing blank, guys. You will be penalized for that. And the second adjustment here says that we bought goods for cash from Makalani wholesalers, right? This is basically what happened here. So here, guys, this is basically simple. It seems like it's a complex adjustment, but it's actually not. So basically what happened here is that firstly the bank balance is going to decrease with the given amount, right? Now there is no specific amount, but let's just assume that the amount is 1,000 rands, right? Or just 1,000, right? So the bank is going to decrease, and then the bank is also going to increase now, because since we bought goods, these goods are assets, so they're going to increase. And when it is like that, right, there is no effect on the other account. There's zero effect here because here, these goods are not capital and they are not profit. So they cannot be here and they are not a liability. Therefore, they only end here in the asset account. Now, moving on to number 3, it says that we borrowed a loan from Nedbank for 100,000 rands and we received a check deposit immediately. Now, with that being said, right, we received the loan, so money came into the account. So this means that we have an increase of 100,000 in our assets. Now, since we took out a loan, this means that the liability is also going to increase. So we have an increase of 100,000 rands here. And this one here just stays blank as it is. We now move on to number 4, right? So for number 4, it says that we had cash sales of goods for 12,000. Now, the first thing that we need to do is we need to increase our assets because we received money from sales. So we have the sales of 12,000 here. Now, is there a liability included here? No, so we leave it as a dash, right? And then here, since our profit is going to increase since we sold, we have 12,000 rands increase in equity, right? Now it is simple as that. Now we move on to number 5, right? Now for number 5, right? For number 5, it says that we paid wages by check, right? We paid wages by check, and the wages were 5,000 rands. So here, the first thing that's going to decrease is our asset, right? Because this money is coming out of the bank, right? It's coming out of the bank, which is our asset. So 5,000 rands is going out of our bank, and by us paying these wages, we are going to decrease our profit. So we have a decrease of 5,000 rands here also. And now there's no liability included, so we leave it out. Right, we leave it out. Now, moving on to number 6, right? It says that we bought a vehicle for 3,600 from SF Motors and we paid it off by check, right? We paid it off by check. Now, it is a vehicle. Is it capital? No, it is not capital. Are we receiving profit from buying that vehicle? No, we are not receiving profit from buying that vehicle. So how is this going to be treated? This will be treated like this. So firstly, our assets increase by 3,600 for vehicles, right? For vehicles, our vehicles have an increase. However, our bank balance, guys, our bank balance now is going to decrease because we're taking money out of the bank. So we have a decrease of 3,600 in bank. And since it is not included here and here, we just put the dash, guys. It is as simple as that. Now moving on to number 7, right? Number 7, it says that we deposited 2,600 into the business bank account, right? We deposited that much money into the business bank account. Now, it is just a deposit. It is not meant for capital because we were not told that it's meant for capital. And the deposit does not necessarily affect our profit, right? It is just a deposit. So what's going to happen here is we are just going to increase on the asset account, and then we are also going to decrease on the asset account. Now, why are we saying that? So first of all, our bank is increasing, right? Our bank is increasing with 2,600 rands, right? However, the cash that we had, guys, the cash that we had is now decreasing. Now, I know it may seem a bit complex or something like that, but not really. Now, let's say we have a cash balance and we have a bank balance, right? Both are our assets, right? Now, if we transfer the cash amount into the bank, balance, then it is going to increase here. However, it is going to decrease here. And that is exactly what is happening on this account right here. Now, with that being said, we can now move on to number 8. And guys, if you don't understand, please make sure to comment so we can make sure that you understand. Please make sure to comment. If you have any questions or you have any concerns, make sure to comment. And while you're at it, please don't forget to subscribe and to click on your notification bells. Now here it says that our owner, right, took a check from the business for their own use. Now remember how in the previous part of this video I showed the ledger accounts. This is where they come in, guys. So here we know that one, our bank is going to decrease because the person took money from the account, right? They took money from the account, so the bank is decreasing. And our drawings are going to increase. Now, when the drawings increase, this means that the equity decreases, right? So we have minus 10,000 right here. Now, there's no liability included here, so we just leave it out like that. Now, for number 9, it says that we bought stationery, right? We bought stationery for cash, right? We bought stationery with cash. So, with that being said, right? With that being said, since we bought stationery, we are going to lose money. Our bank balance is going to go down, guys. So, minus 400 rands, right? And then also, one thing that you must realize is stationery is an expense. Now, if you look at profit, what affects our profit? It's our income and our expenses, right? So if our expenses increase, that means that the profit will decrease. Therefore, we minus the 400 here, right? The decrease in 400 is caused by expenses. And there's no liability involved, so we leave it out like that. And then moving on to number 10, right? Now, number 10, it says that we received a check from Spar Traders for services that we rendered, guys. Services that we rendered. So the first thing that's going to happen here is that our bank balance is going to increase since we received a deposit from them. Basically, they deposited money into our account since we delivered their services to them. Now, there's no liability involved here. Then, once again, we talked about profit. Now, with profit, we have income and we have expenses, right? So, this is an income. So, this means that we are going to have an increase in equity of 3,500 rands, guys. So, it is simple as that. When we look at capital, it will be specified that this is capital. If it's not specified, then you do not count it as capital. And that is what we've done here. Now, this vehicle was not classified as capital. If it was classified as capital, then we were going to have it be on the side. But however, it is not. So this is how we treat adjustments like this. So when you first look at the accounting equation, I want you to first look at these things. Number 1, is it capital? Right? If it's capital, then you know that your adjustment is going to come to the equity. Number 2, is it a profit? Now, when you talk about profit, you must look out for keywords. Look out for income and expense. If the adjustment is not an income, an expense, or capital, then equity is not going to be involved. So that leaves these two accounts now. Now, if you have a liability that is paid off, you would obviously have an amount here and here. And if you take out a loan once again, you would have an increase in assets and in liabilities. However, if it happens that the transaction is not involved in the equity and the liability, then you can expect a double entry here, seen in number 6 and number 2, right here, right? So basically, you would have an increase and a decrease, because here our vehicles increases, right? Our vehicles increase, and that is an asset. However, for us to buy our vehicles, we take money from the bank, and the bank decreases. So that's just how it works, guys. So let us move on to the next adjustments. So moving on to number 11, right? Moving on to number 11, it says that here that we had a credit purchase of goods, right? Now, when we think about credit, you must think about debt. We're taking something on debt, right? So debt is a liability. So with that being said, we bought goods, right? So cool. Since we bought the goods, our assets is going to increase, right? Because this could be our inventory, this could be whatever it is going to increase. So here we have an increase of 5,000, right? However, since we bought it on credit, right, it is also going to increase our liability. Now, since we have this and this here, equity is not involved, you leave it out just like that. Now, moving on to number 12, right? Number 12 says that we, as the business, we sold goods on credit, right? We sold goods on credit to M. Jackson. So what does this mean? This means that someone is going to owe us. And since this is an income, basically, because we sold goods, we are going to have an effect on the asset and the equity account. So here we have, it is basically very simple. We have an increase of 1,700 here, right? 1,700. This is from your debtors, right? Debtors account. And on this side, we also have a 1,700 increase, right? From what? From our sales, right? As simple as that, sales. So there's no liability involved here, so we scratch it out. Now moving on to number 13, right? It says that M. Jackson returned the damaged goods, right? So as you can see, we gave them goods on credit. We perhaps gave them goods that were damaged, so then they returned them. So here, once again, this just means that our debtors account is going to decrease, and our debtors account is an asset, so we say minus the 800, right? The 800. And then here also, right, our profit is going to decrease now, right? Because basically our income is decreasing, our sales is decreasing. So we minus the 800 here. So here it is sales return, basically. Just like that. And then moving on to the last equation, guys, the last equation. Moving on to the last equation here, right? So basically here, it says that we returned goods to OK traders, right? Us, right? We returned goods to them, and we were a debtor to them. Basically, we took goods on credit from them. So with that being said, guys, what does this mean? This just means that if we took it on credit, right, our liability is going to decrease now. Our liability is going to decrease because we were owing them. However, we returned the goods to them, right? And similarly enough, it would be the same if we perhaps done it with cash. So to treat this, let us do it in two ways, right? Two ways that we're going to do it. So the first one is basically with the credit situation, right? So we know that the goods that we bought from them, we are taking them back, so we are going to lose them. It is 1,200. Now these goods could have been for trading stock or anything like that. We are going to lose them. And then once again, since we took these on credit, right? Since we took this on credit, this means that our liability is going to decrease since we are taking it back, right? So guys, thank you for watching this video. If it helped you, please make sure to drop a like and to subscribe. And if you need a extra video on helping you understand this, please don't be afraid to comment. Just comment, and we will create another video on the accounting equation to help you further understand it. So obviously we have all of these. So to write our totals, right? Now for time purposes, we have already added them up. So to have our totals here, our total assets amount to 154,800. our total liabilities amount to 103,800, and our total equity amounts to 51,000. Now, if you add these up, guys, you will realize that it will give you the 154,800. So with that being said, this is the end of the video, and thank you so much, guys, for watching once again. This helps our channel grow, so please make sure to like and subscribe, because that's the only way that you can support us in growing this channel.
Academic Academy Essay. Lock in, learn, improve, achieve. Academic Academy.